Most newcomers and Canadians under 30 are funding the wrong account first, not because the bank lied to them, because of a rule buried in the CRA's FHSA regulation that nobody surfaces. If you owned a home anywhere in the world in the last 4 years, Mumbai, Manila, Lagos, London, Toronto, doesn't matter, you cannot open an FHSA. And on top of that, there's a carry forward trap that costs you $8,000 in tax-free room permanently. So today, the order: TFSA, RRSP, or FHSA for newcomers and young Canadians in 2026 using the actual rules from Canada.ca. 3 accounts, 3 sets of rules, 3 different ways the math breaks. By the end of this video, you'll know exactly which one to fund first, based on 3 inputs: how long you've been a tax resident, your income tier, and whether you actually qualify for an FHSA. That's it, 3 inputs, 1 answer. No, it depends. No financial advisor hedging. Real numbers, real ranges. Save this video. Bookmark territory. Quick one. If you're new here, hit subscribe. Canadian finance, real rules, no hedging. A couple of you told me last video I talk fast. Fair call. I'm a Kiwi, mate. We just do that at home. I've slowed it down a notch. Back to it. Okay, here's why this is confusing. I walk into any Canadian bank and the script is the same. Open a TFSA, contribute every year. That's the plan. That advice was written for someone born in Canada who's been earning income here since they were 18 and who already owns a home or doesn't want one. And if that's you, great, the default works. But if you landed in Canada in the last 5 years, or you're 24 and renting in Toronto, or you're thinking about a first home in the next 10, your situation isn't the default, and the order matters. Because each account gives you something different: tax-free growth, a tax deduction now, or both. Pick the wrong one first, you leave thousands on the table. Oh, right, so let's break them down. TFSA, tax-free savings account. Despite the name, it's not a savings account. It's a wrapper. You can hold cash, ETFs, stocks, GICs, anything, and every dollar of growth inside it is tax-free forever. 2026 contribution room, $7,000. Cumulative since 2009, if you've been a tax resident the whole time, $109,000. Here's the newcomer rule everyone gets wrong. Your TFSA room does not start in 2009. It starts the year you become a Canadian tax resident. Canada.ca is explicit on this. There's an example in their own documentation. A guy named David landed in 2020. His room starts 2020, not earlier. Right, so when does the TFSA win? When you don't have much income yet, and a tax deduction wouldn't save you much anyway. When you might need the money in the next 5 years: wedding, car, emergency fund, gap year. And when you want flexibility, withdraw anytime, no tax, and the room comes back the next calendar year. That last bit is huge. Nobody talks about it. RRSP, Registered Retirement Savings Plan. This one's a deal you make with the government. You put money in, you get a tax deduction this year. The money grows tax-free inside. But when you pull it out in retirement, every dollar is taxed as income. 2026 contribution room, 18% of your previous year's earned income, capped at $33,810, up from $32,490 in 2025. Here's the catch for newcomers. RRSP room is based on the previous year's Canadian earned income. So if you landed last year and didn't work in Canada that calendar year, your room this year is 0. Yeah. That one stings. When does the RRSP win? When you're earning above $58,500. That's the federal bracket where the rate jumps from 14% to 20.5%. Below that, the deduction's not powerful enough to justify locking the money up. Above it, every dollar in saves you 20 cents or more in tax. RRSP wins for high earners, late 30s and up, with stable Canadian income. FHSA, First Home Savings Account. This one's the unicorn tax deduction going in like an RRSP, tax-free growth like a TFSA, tax-free withdrawal if you use it for a qualifying first home, $8,000 a year, $40,000 lifetime cap. But, and this is the part nobody surfaces, there's a global qualification rule. To open an FHSA, you cannot have lived in a home you owned anywhere in the world in the current calendar year or the 4 preceding calendar years, anywhere. Mumbai, Manila, Lagos, London, Toronto, doesn't matter. If your name was on a deed and you lived in it in the last 4 years, you don't qualify. Right. And the carry forward trap. You can carry forward unused FHSA room, but only up to $8,000. So if you open the account, contribute $0 in year 1, then try to dump $16,000 in year 2. The system caps you at 16, your 8 in year 1 room plus 8 current year. But if you waited 2 full years to open it, that first year of room is gone permanently. $8,000 of tax-free room, you've been vaporized. When does the FHSA win? Pretty much always if you qualify. Even Jamie Golombek, Managing Director of Tax and Estate Planning at CIBC Private Wealth, one of the most quoted tax voices in Canada, said it plainly in March 2023 in Investment Executive. Quote, FHSA first, RRSP with a view to using the HBP second, and third, the TFSA. End quote. That's the contrarian order from someone who is not selling you anything. Right, side by side, TFSA, $7,000 annually, no deduction going in, tax-free growth, tax-free withdrawal, use the money for anything. RRSP, up to $33,810 annually, full deduction going in, tax-free growth, taxed on withdrawal, use it for retirement or pull up to $60,000 under the Home Buyers Plan, but you pay that back over 15 years. FHSA, $8,000 annually, $40,000 lifetime, full deduction going in, tax-free growth, tax-free withdrawal for a qualifying first home only. Notice something? FHSA is the only one with all 3 tax breaks. Going in while it grows and coming out. That's why Golombek puts it first. The math is just better if you qualify. So what's the default order most people get told? Max the TFSA first, then RRSP, then maybe think about the FHSA. Why is that the default? Because TFSA is the easiest to explain. The bank teller doesn't have to ask about your income, your home ownership history, or your retirement plans. It's the path of least resistance. But for a newcomer landing in Canada at 28 on a $60,000 salary who's renting and might want to buy a place in 5 years, that order is wrong on every single account. You'd skip the FHSA and lose tax-free room you can never get back. You'd skip the RRSP refund, even though you're in the second federal bracket. And you dump money into a TFSA, where the tax break doesn't compound nearly as hard. The default is wrong. Here's what to do instead. Right, the decision tree. 60 seconds, 3 questions. Question 1. Have you owned a home anywhere in the world in the current calendar year or the 4 before it? If yes, FHSA is off the table. Skip to question 2. If no, and you think you might buy a first home in Canada someday, even 10 years out, open the FHSA right now, even if you contribute $1. Just open it. The clock on your contribution room starts the day you open it, not the day you decide to use it. Question 2. Is your income above $58,500? If yes, RRSP gives you a federal deduction at 20.5% or higher. If no, RRSP can wait. The deduction is not big enough to justify locking the money up till retirement. Question 3. Do you have an emergency fund and short-term goals? Wedding, car, travel, business, anything within 5 years? If yes, TFSA is your home for that money. Flexibility matters more than the deduction. If no, and you've already opened the FHSA and maxed RRSP to the bracket, then yes, TFSA is the next stop. That's the framework. FHSA, RRSP, TFSA. For most newcomers and young earners. See, in that order, let's run this on the newcomer we met earlier. David, $60,000 salary, renting in a Canadian city, hoping to buy a place in 5 years. Step 1, open the FHSA. Even with $8,000 a year, 3 years in, that's $24,000 of contribution room, locked and growing tax-free. Step 2, RRSP contribution of $3,000. David's in the second federal bracket, 20.5%. So the deduction puts roughly $600 back in his pocket at tax time, at a provincial rate on top, depending on where he lives, and the number gets bigger. Step 3, TFSA. Not because it's the priority, but because the $800 a month David can spare doesn't all need to be locked up. The TFSA is the emergency fund, and the Christmas trip fund, and the engagement ring fund. So, in year 1, David has put real money into all 3 accounts, and the government is handing back hundreds of dollars to do it. Now, saving $20,000 a year on a $60,000 salary is ambitious. Most people won't hit that. But here's the thing. Even at half this pace, the framework still wins. The order matters more than the dollars. Multiply the right order across 10 years, and you're looking at tens of thousands of dollars that the default would have left on the table. Same income, same person, different framework, and the math changes everything. Right, recap, TFSA, RRSP, FHSA. The default Canadian order is wrong for most newcomers and most under 30s. The actual order for most people is FHSA first, if you qualify under the 4-year global rule. RRSP second, once your income clears the 58.5 bracket. TFSA third for flexibility and short-term goals. One more thing, the FHSA plus the Home Buyers Plan can be stacked. $40,000 from the FHSA plus $60,000 from the HBP is $100,000 per person towards a first home. $200,000 for a couple. Tax advantage. That's a separate video. Disclaimer, and you knew this was coming. I'm not a financial advisor, I'm not an accountant, I'm not a planner. This is general information based on publicly available rules from Canada.ca and the CRA. Run your own numbers. Talk to a qualified professional before you do anything with real money. If this helped, subscribe, leave a comment with your situation, and I'll see you next Wednesday. Cheers.